Hi, I'm Jenny Brown. Welcome to this week's MFB News. This week we're coming live from the studio in the office. You never quite know where you're going to be with me, do you? I hope you're all doing really, really well. If it's your turn for half-term week, I hope you're having a great week. And for those romantics among us, of which I must admit I'm not one of them even slightly, I hope you had a really nice Valentine's Day. Now, in terms of what we've got for you this week, with inflation now topping 5.5%, rumours of a Bank of England base rate increase again next month. It's going to come as no great surprise to you, particularly if you watch these videos regularly. The interest rates from the lenders are now really starting to creep up quite rapidly. So I'm going to go through in a bit more detail what's been happening there. We've also got some new products come to market as well, which are very good, so we're going to cover those off. And then what we're going to do is we're going to turn our focus to the MES changes, the EPC requirement changing in 2025, and really delve into some more data that sits around that. Shawbrook have just produced a really fantastic white paper which tells us a bit more about landlords' understanding about what's going to be required of them, the preparations they're making, and all this kind of stuff. So it's going to be really interesting to go into that bit more detail, because I know it's an incredibly hot subject for landlords at the moment. Okay, so first up, some rate increases for you. Now, what's really interesting, when lenders release new products which have come down in price or are limited edition and therefore sort of slightly more competitive than their standard product offering, they're very kind of bold and obvious in terms of what's actually going on. So, wow, look at this amazing new lower rate that we're introducing. When they're increasing their rates, they word things slightly differently, so it's not always immediately obvious. What they will just say is they're pulling their product set, releasing a new set of rates the next day. What they don't tend to do is then say, oh, and by the way, they've gone up by so many basis points. So we have to read a bit more between the lines. But look, so what's been happening in the last week? So first of all, we have seen Platform Home Loans withdraw a selection of their buy-to-let products. They haven't replaced these with anything. They've simply pulled a slug of their products away from the market. We've also seen BM Solutions make changes. Now, interestingly, they've made rate decreases of up to 0.03% and increases on different products of up to 0.13%. So some have gone up a bit and some have come down a tiny bit. What this means basically is for BM Solutions, their pricing now starts from 1.58%, which actually in the scheme of things is still very, very low. Virgin have also increased their rates. Depending on the product, the increase varies from between 0.1 and 0.27%. So their pricing now starts from 1.67. We've seen the Leeds Building Society increase their rates by up to 20 basis points. Pricing here now starts from 1.77%. Now, all of these rates that I'm saying, the way the pricing starts from, they're still actually really good deals. So what you can see is that despite the fact the pricing has gone up, actually the interest rates that you can still secure at this moment in time are very, very good. So, you know, I'm sure you can read between the lines there and see that actually, you know, there's still an opportunity for you to get in and secure a very competitive interest rate. Now, the Coventry have also withdrawn a whole bunch of their products, including their flexible fix and portfolio landlord products. They haven't yet announced what they're replacing them with, so all I know at this moment in time is that their product set has been withdrawn. I would imagine that because they're not telling us what the future rates are going to look like, it will be an upward pricing move. We've also seen Santander increase their buy-to-let pricing by up to 10 basis points. Their rates now start from 1.64. And we've seen the Mortgage Works make some increases to their pricing as well of up to 40 basis points. So with the Mortgage Works, they've got, I think it's fair to say, kind of three different product sets. They have personal name mortgage products for landlords with up to 10 properties, personal name with landlords up at more than 10 properties in the background, and then they've got a limited company offering as well. So if you're a landlord with less than 10 properties, pricing is now from 1.09. If you've got more than 10 properties, it's from 2.39, and if it's limited company, it's now from 2.49%. So as you can see, quite a lot of rate movement upwards in the last week. Again, this is really just a continuation of the reaction to base rate going up, cost of funds in the money market spiking as well. So we're going to see more of this over the coming few weeks. But like I say, there really is an opportunity with rates still starting from 1.5, 1.6%, even lower for some lenders still. There is a really great opportunity to get in there now and secure yourself a good rate before things continue to go even further. Now, Vida Home Loans, to bring you some good news, have released some new limited edition products. They withdrew their most recent set of limited edition products last week, which we reported, and they've now brought out a replacement set of limited edition products. Just to say that limited edition products is where a lender will say, okay, here's our kind of normal product set, but what we're doing is releasing some new rates which are invariably slightly more competitive than our standard product set. And these are only available for either a limited period of time or a limited amount of lending. So it could be that we're willing to lend up to, £25 million on this particular interest rate. Once that money has been used up, then we withdraw the rate again. So these are available, as the title would kind of indicate, for a limited period of time. Now, the rates that are brought out are actually very competitive. They've got pricing from 2.99% with a 1% fee, from 3.04% with a 1,495 fee, so a flat arrangement fee there, which some people prefer, and often mathematically these can work out better for you just depending on the numbers involved in terms of how much you're actually borrowing. And then what they've also done is brought out a HMO and multi-unit product where the pricing now starts from 3.19% with no arrangement fee, which is very good. Now, in terms of their HMO multi-unit block offering, so we're looking at HMOs of up to 8 bedrooms and multi-units of up to 5 self-contained units. So if you imagine you can mortgage a block of flats up to 75% loan to value from 3.19% with no arrangement fee, it's a pretty decent offering. Now, Vida are able to lend to individuals and also limited companies. The limited company offering is quite vanilla, so we're looking at SPVs, we're looking at non-layered companies. They don't mind how many properties you've got in the background, which is really good. So really encouraging to see Vida bringing out actually what has put them not at the top slot in terms of pricing, particularly in the more specialist end of the market, so your limited companies, HMOs, multi-units, but certainly pushed them much nearer to the top of the tree in terms of competitiveness on rate. EPC Changes. Okay, so Shawbrook have released a white paper which I found absolutely fascinating to read, which talks around the upcoming changes to EPC requirements. Also about really, well, what they've done is they've surveyed lots of landlords and they've published lots of data which really talks around where landlords are with things at the moment, what their plans are, which I just found absolutely, so fascinating. So look, 36% of PRS properties were built before 1940. And 30% of these have an EPC rating of D or below. So these are all the properties which are going to need work doing to them, which really just kind of starts to give you an indication of the scale of the challenge ahead. Now, 23% of all PRS properties, so almost 1/4 of all properties that are rented out privately, have an EPC rating of D or below. So the task ahead is absolutely massive. Now, in terms of landlords' kind of plans for doing remedial works, so first of all, of those surveyed, 31% said that they can actually afford to cover the cost of any works that need to happen. The remainder are either going to need to borrow the money one way or the other, or they simply don't know how they're going to fund the works. 42% of landlords surveyed said they would actually need the tenant to vacate the property while the remedial works would be carried out, which means that essentially there's going to be an additional cost here, because if you ask a tenant to move out temporarily, obviously you have to cover the cost of their housing during that period of time. So it's going to be potentially a large financial burden for a lot of landlords who are then sort of simply saying, but I don't even know how I'm going to pay for this at the moment. So there's obviously a lot of worry amongst those who are really starting to turn their thoughts to how they're going to tackle this particular challenge. Now, in terms of timeframes, most landlords are planning to start works to their properties in the next 14 months, but 7% of landlords are actually saying they need to start in the next 3 to 6 months because of the sheer task or scale of the task ahead. So lots of people are now really turning their thoughts to the when they need to get the work going. Within the next 2 years, really it's a year's time where people are really thinking about kickstarting their improvement projects. Now, in terms of the fallout of this and landlords' buying habits, so 15% of landlords are now planning to only buy properties that have been built in the last 20 years because of the ease of upgrading these properties to have better, stronger EPC rates. 24% of landlords will prioritise buying a property with potential to reach a rating of C or above. 25% of landlords will avoid buying a property with a low energy efficiency rating. 30% of landlords would be inclined to buy a property which already holds a C rating. So what you can see here is that actually landlords' buying habits are going to change, because a lot of landlords, what they don't want to be doing in the coming months is be buying a property knowing that actually they're then going to have to do a load of works and they're going to be focusing on those greener properties. So what does this mean for you guys? So first of all, really just to be aware that this is a challenge that landlords are facing. It's a large challenge. I know when we speak to some of our clients, they're saying, well, look, you know what, I know this actually needs to happen, but I'm waiting for some sort of government grant or scheme to be launched. Now, will one come to the surface or not? I mean, we don't know. They have launched previous incentives for green improvements which haven't gone so well. One would like to think that there would be some kind of help from the government, but how that would look and whether it's worth waiting for would remain to be seen. So that's kind of the first school of thought of some of our clients. We are seeing clients who are really kind of mindful of these changes, and for those people who are now remortgaging, they're actually raising funds to cover their green improvements, which they may not be doing for another year or so, but they want to make sure they've got sufficient capital ready to cover the costs of the works when it becomes appropriate to do so. So well done to those guys for thinking ahead. And in terms of buying habits, you know, I suppose really fundamentally, for landlords going forward, you know, looking for greener properties which are going to be either C or above straight away or can be changed to a C or above very easily, are really going to be where the priority sits. I suppose that does really then pose a opportunity for those investors who are looking at older properties in terms of being able to probably pick up something which is slightly less desirable to other investors because of the EPC rating, meaning you could probably get the property much cheaper, do the works yourself. Obviously that comes with a cost, but it could also mean that the return on that particular investment could be much higher for you. And that is everything for us this week. Thank you, as always, for joining us. I hope you find that helpful. Hopefully next week we're going to have something more to talk about than interest rates going up. I know it's not the most exciting or wonderful news, but look, if you are thinking about remortgaging in the next really 6 or 7 months, do give us a call. We can lock in rates at today's money for you, despite the fact you're not going to be needing the money for 6 or 7 months' time. That's definitely possible. So do give us a call, 0345 345 6788. Have a look at our website, mortgagesforbusiness.co.uk. For those of you who are on half term, have a great rest of your week. For those who have got half term next week instead, good luck. I will catch you all again next time.